Hi guys, welcome to this Money Control live stream. You're watching Morning Trade with me, Nandita Khemka. It's a Thursday morning. Cues coming out of global markets are fairly tepid, given the fact that we had an FOMC meet outcome last night as well. And lots of stocks in focus as well. We'll be talking about that, and we'll also be taking all your stock-related queries with our technical expert on the show. So if you have any queries, send them in to us on our YouTube feed and we will take them up. But before we move any further, let's take a look at what the headlines are looking like this morning. Wall Street drifts lower as the US Fed leaves interest rates unchanged but hints at one more rate hike before the end of the year. Fed Chair Jerome Powell also predicts rates will remain higher for longer and says a soft landing for the economy is still a possibility. Asian markets open with losses on a weak handover from Wall Street. The Nikkei and Kospi are down nearly 1%. The GIFT Nifty, meanwhile, is hinting at a gap-down start for the Indian market once again. Crude eases to a one-month low to trade around the $93 a barrel mark. Prices cool off after the Fed delivers a hawkish pause and signals higher for longer rates. The market looks ahead to policy decisions from other key central banks, including the Bank of England and Bank of Japan. The Nifty saw its worst day since July yesterday. However, it did manage to shut shop above that 19,900 mark. As much as 3 lakh crores wiped off in yesterday's sell-off, braced for more volatility on weekly expiry day. Stocks in the spotlight today will be Infosys as it teams up with Nvidia to build generative AI. SJVN also in focus as the government looks to offload nearly 5% stake via an offer for sale. And EMS makes its stock market debut today. It is expected to see a strong listing despite a subdued market. Market regulator SEBI's board will meet today to discuss a range of issues. In fact, on the agenda will be extending relief to large corporates, raising 25% of debt from corporate bonds, FPI, and foreign investments through various routes and regulations for index providers. Well, let's then get on to the top story at this hour. Of course, the Fed has left the rates unchanged. In fact, it has hinted at one more rate hike going forward this year. And for the next year, in fact, it has reduced the number of rate cuts it had indicated earlier. But let's listen into what the Fed chairperson Jerome Powell had to say right after the announcement of this decision.
In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025.
Well, let's now get on board to discuss what the Fed statement means, what are the changes like, and what does it mean for equities and risky assets going forward. Let me now introduce on the show Seth Freeman, Managing Director at B. Riley Advisory Services, joining in this morning. In fact, he's joining in live from San Francisco. Hi, Seth. Thanks a lot for taking out time and joining in this morning here in India. Well, looking at the Fed statement, a lot has changed when it comes to how Jerome Powell, in fact, views the economy going forward. He's of the view that, we are in for a soft landing going forward. Do you think the Fed is being a little too optimistic when it comes to the economy? Because rates are at 22-year high. In fact, we'll have to, wait for some lag effect and the impact of the rate hikes, 11 rate hikes that have been announced over the last 1 year to kick in. So what is your assessment of what he has to say with respect to the U.S. economy?
Well, good morning, and thank you for having me once again. It looks like the Fed is going to be successful, at least as of today, to have a soft landing. But it's very clear that we're going to see these sustained, high interest rates for much longer than originally expected. The view before was that we were going to be going down to 4.6 next year, but it doesn't. We just heard today that that's not going to be the case. This is going to put enormous ongoing pressure on businesses and real estate investors, and particularly medium-sized businesses.
Right, higher for longer, that's the narrative. And, as you mentioned, the businesses will come under pressure as well. But what does it mean for risky assets like equities? Do you think investors will turn more and more risk averse, given the fact that, since the last Fed meeting, we've seen Wall Street shed somewhere around 2 to 3%. So going forward, do you think investors will get a little more risk averse and US equities will head southwards?
It's definitely, implicitly negative for equities, although look at the overall U.S. market gain we've had, this year, virtually 17%. That was completely unexpected by most investors. It's going to put a lot of pressure, more pressure, I think, on emerging markets, just in terms of relative dollar strength. And, and it's going to affect money flows. But I can tell you, for example, bankruptcies in the United States are up 23% year over year as of the end of June. And in the first half of this year, compared to last year, bankruptcies are up 68%. So what the Fed is really looking at, though, is the labor market. And we still have a fairly strong labor market, despite higher interest rates and continuing announcements of layoffs.
Right. What about the dollar index going going forward? 105 is where it's at right now. Do you expect the dollar index to strengthen further going forward?
I think the dollar will continue to strengthen in the near term. We saw a little bit of strengthening right after the Fed announcement, and right now, it's still at the moment the reserve currency, and we have you said earlier a little while ago about oil prices softening a bit. That's also a big overhang across the world, and particularly in emerging markets.
Right, from the emerging market pack, we've seen India hit fresh highs, but then it has come off over the last few sessions. Of course, it's the oil price rise and, FII outflows that are weighing in on the markets. But going forward, among the, emerging markets pack, would you say India is the one that stands, as a bright spot? Or would you say there are other markets like Taiwanese markets or, Chinese markets, so to say, looking more attractive now?
No, India is going to continue to be a recipient of investment. And there's this ongoing friction, of course, geopolitical issues involving China. And, the General Assembly has been taking place, and Vietnam and other Southeast Asian countries are eager to replace trade and investment that was previously going with China. And we're also seeing something called nearshoring. At this time, the U.S. and Mexico are bigger trade partners than U.S. and China, and that's a very big change. But in general, I believe that in the medium term, India is going to continue to be a recipient of investment and greater exports as well.
All right, that's the view then. Things looking brighter for India in the emerging market pack. With that said, thanks a lot for taking out time and joining in this morning. It was a pleasure speaking to you and sharing this conversation with you. Well, with that, let me also bring on board our technical expert for today. Joining me is Kush Bohra, who's the founder of kushbora.com. Good morning, Kush. The setup looking fairly negative this morning as well. GIFT Nifty, I think, hinting at another 0.5% downtick. Yesterday, we just about managed to latch on to that 19,900 mark. But given the fact that it's weekly expiry, would you say that, brace up for more volatility? And what are the next support levels you'll be watching out for on the downside?
Hi, Nandita. First up, thank you for having me on the show once again. I think after yesterday's fall and the today, gap down opening that the GIFT Nifty is suggesting, I think there's a temptation to perhaps go long, on the indices. I would, strongly urge to resist that, and I'll give you a very simple reason. Today being the weekly expiry, there should have been a very strong call base and a put base. The call base at 20,000 is absolutely fine. The put base is not so strong. the 20,000 call base is actually double of what the put base is. So perhaps the market preempted it, yesterday, perhaps day before, that, there is some more, downside left on the indices, and hence you didn't see that put base coming in. So my suggestion would be to perhaps still hold on. When you ask about what's the next key level that we're looking at, it's about 19,700, where the 20 DMA for the Nifty lies, and 19,600. So that's the zone where, we're looking at perhaps Nifty consolidating. It could, perhaps give a rebound, but, I won't preempt it. I will wait and watch and see if that, put base does actually come in, that, support does come in after 2 days of, dips. So I won't be preempting, anything. I'll just wait for the market to sort of form that base. And the key levels that I'm looking at are 19,700 on the downside and 20,200 on the upside on the Nifty.
All right, 19,700 on the downside. But before I move on further and talk about the stock of the day, I want to get your thoughts on HDFC Bank. How should one approach that after yesterday's sell-off? Of course, there have been concerns flagged off in terms of return ratios being impacted, in the aftermath of the merger, and brokerages have cut their target price significantly going forward on HDFC Bank. On the charts, how much more of a downside, and should one utilize this downtick to accumulate the stock and perhaps wait for things to get better?
Well, for a brief part, HDFC Bank was starting to look good. If you see, it was starting to, trade above some of its key averages and, forming, getting good volumes. But yesterday's move and the day before's move is sort of negated all of that. HDFC Bank has not been a trader favorite, at least, in the recent past, given the kind of volatility, it has seen. So I would suggest that, from a trading perspective, it's best to perhaps, stay away from it right now. Time and again, HDFC Bank has proven to be an investor favorite. So I would suggest if someone is really keen, perhaps this is a good time to start accumulating this, at current levels, buy it at all dips, but don't expect a very quick, sharp turnaround on this one. As far as levels go, it's actually at the cusp of, a very strong support zone, which is 1560 odd. Now, if it does not hold, then I'm afraid, 1500 is also a level that the stock could test. But as I said, from a trader perspective, I don't think, too many people have had a position in this anyway. And, being an investor, you might want to perhaps continue your SIPs into this one if you've already got some. But from a trading perspective, I'd say it's a clear avoid, at least for now.
All right, avoid it for now. That's the call on HDFC Bank with the trading perspective at least. But let's talk about the stock of the day. SJVN is on my radar, given the fact that the government is looking to sell somewhere around 5% stake via an OFS. Well, the OFS for non-retail investors will be open today, and for retail investors, it opens tomorrow. And the floor price has been set at 69 rupees per share, a discount to that 83 rupees or 82 rupees it's quoting at the current juncture. But Kush, if you look at the stock at 52-week highs, good going over the last 1 year, I think, in fact 1 month rather, it has gained somewhere around 50%. But how much more of an upside do you think this stock can see? Can we test levels of 100 anytime soon?
Well, the only shining beacon in this entire market has been the PSC space, and companies from various sectors have sort of started taking the mantle up. SJVN is one such case in point. In fact, the stock was languishing at about 30 and not too far back. This is beginning of April. So it's already seen a stupendous run. What's interesting is that if I look at this across time frames, be it daily, be it weekly, the stock does not seem a little overstretched. Okay, perhaps on the weekly charts, it does look a little overstretched. But off late, we've started to see the volume pick up. The stock, taking support at good 75 levels and then headed up. So while 100 is a bit of a stretch, I wouldn't rule out, a move somewhere close to, 89 and 95 odd levels in the current setup, in the current momentum. And despite the kind of sharp run up that we've seen over the last, 5-7 days, the stock is a little away from the overheating territories. So this is suggesting two things. One, if you have an existing position, it's not a bad idea to keep your trailing stop loss at, 75 and ride the momentum. Don't be in a hurry to sort of book your profits and exit. Ride this momentum. And if you're looking at a fresh entry point, same level will act as your stop loss, and the targets, as I said, would somewhere close to 89 and 95 levels. So from both perspectives, a fresh entry or an existing position, ride the momentum is the view on SJVN for the moment.
Well, ride the momentum on SJVN, that's the view. But let's talk about, the hot brokerage call of the day. In fact, on Indigo, Morgan Stanley has an overweight rating, target price at 3,217 per share. It believes that the rising ATF prices amid a surge in crude prices and, a weaker rupee poses a 10 to 13% downside to its FY24 EPS estimate. But for FY25, the EPS estimate is at somewhere around 136 rupees and that has limited downside going forward. But Indigo as a stock has been, of course, coming under pressure, given the fact that we've seen a surge in ATF prices. Going forward, if somebody wants a trade in this counter, should one even look at it at the current juncture?
Well, with all kind of the pulls and the pushes that we've been witnessing in this, I'd say for me it's an avoid. See, from the near term perspective, the stocks actually dipped quite a bit. 2700 is close to the level where it made a high, and then it's just only been one way down. Now it's attempting to find a base somewhere close to 2350, 2400 kind of levels, but it's not such a strong base, strong move yet. So will this stock perhaps rebound from here? Nothing on the cards suggesting that it just might. Also, do I go short from here? Again, doesn't entice me as much, because 2350, 2300 are the levels where the near term supports arise. So for me, this is a wait and watch kind of a stock. See which which side the stock turns and perhaps then take a call. The sentiment definitely is weak, but I wouldn't actually trade on this one, either on the long side or the short side. As I said, it's on the cusp of a very delicate situation right now. So I'll wait for the stock to perhaps take a turn and then decide a strategy on this.
All right. Clear avoid at the current juncture, at least Interglobe for you. But let's take up some viewer queries now, Kush, that are trickling in this morning. I want to first take up a query on Hindustan Copper. This one is coming in from Raja Pasala. Wants to know your thoughts on whether he can average at the current price and perhaps exit at a later time. If you look at the metals pack, it was among the top laggards yesterday, and particularly Hindustan Copper, 1 month basis has done pretty well, 17% uptick or thereabouts, but off late it has been a little bit of, has been a little bit volatile. So would you say that any dip is an opportunity to average at current levels?
So for the metal pack in general, that's the view that we have. When you talk about the likes of Tata Steel or Hindalco for that matter, JSW Steel, Hindustan Copper also to some degree, that's the general view that most of the dips off late for the last couple of months have actually been a buying opportunity. Now, averaging is not something that as a trading strategy we normally go by. So that is not something that I would recommend. However, from the near-term perspective, what I would say is be a little cautious on this one. The bias for now remains a little positive, but what I'm seeing here is something called the RSI negative divergence, where the prices have actually shot up, but the relative strength is not, to be found to be the same, momentum or the same degree as it was when it made the previous high. So the RSI negative divergence is perhaps just putting me a little bit on the caution mode. However, there isn't a confirmation yet because we need the stock to slip either below some of its key levels. It's holding the 20-day moving average for now. So I wouldn't recommend shorting or rather averaging this one. What I would suggest is hold on to this one with a tight stop loss somewhere close to 154 kind of levels. If it does hold up around these levels, which is the 20-day moving average, it could very well further move back to 166 and 175 kind of levels that we had seen very recently. So no averaging, but hold on to the existing position with a tight stop loss.
All right, hold is the call on Hindustan Copper, but avoid averaging at current levels. Hope that answers your query. But let's take up a query on Reliance Industries. It was one of the top contributors to the kind of weakness that we saw on the index yesterday. We have a query coming in on this stock from Yagnesh. Wants to understand whether it's the right time to accumulate at current levels given the kind of correction that it saw yesterday. Would you advise investors to buy into Reliance Industries on dips?
Yeah, I'll assume you framed your question absolutely, carefully, which is, would you advise investors? In that case, my answer would be yes. See, the view here is very similar to what I just mentioned about HDFC Bank. Even Reliance has not been on on traders' radar for a while now, because after the Jio demerger, the stock's actually been under pressure for a while. some attempts, but they have not been sustainable. While we still believe that in the long term, medium to long term, Reliance Industries would perhaps turn out to be one of the one of the better performing stocks, and hence of course benefit the market overall. But we're concerned about the near term. As far as investing goes, as I said, same view as HDFC Bank. Continue your SIPs in this, continue accumulating this. But from a trading perspective, it's a clear avoid. The stock has been under pressure and not been able to cross some of the key levels also. And time and again, all bounces have been sold into. So 2350 is one very strong support zone. We believe that that is a level that the stock should respect in the near term. So from an investment perspective, continue your SIPs. From a trading perspective, it's an avoid for now.
All right, that's the call on Reliance. But let me take up a query on HFCL. Nitin Limai wants to know your thoughts. This stock has done fairly well over the last 6 months, and even on a monthly basis has given good double-digit returns. But going forward for the near term, how are the charts looking for this one?
Oh, not too bad. If I look at the near-term move, as you rightly said, the stock's actually done rather well. It's been affected by the market volatility, I would say, but on the whole, the stock's actually holding up quite well. Even in the downturns, the stocks held to its 20-day moving average and its 50-day moving average for the most part, and the similar setup is witnessed here also. Even yesterday, the stock actually was a little volatile, but still held up to its 20-day moving average, and the bias here remains positive. The momentum's missing, so there could perhaps be some weeks of holding before it sort of shoots higher. But the overall setup is positive. I wouldn't rule out a move somewhere close to 79-80 odd levels. And for an existing position, a very clear stop loss is at 69. So I would hold on to this one if I have an existing position with a stop loss of 69 and a target of 80.
All right, that's the view then. Hope that answers your query. But let me take up one last query then. This one is coming in from Vijay, wants to know your thoughts on Dilip Buildcon. He has 6,000 shares at the price of 332 rupees a piece. Making a bit of a loss here. 307 is where it's quoting at. What would you advise him to do? Would you advise him to hold on and perhaps wait for an uptick and then take some profits, or book losses?
Well, on a weekly setup, the stock's actually not done too bad. If I look at it from somewhere close to mid-May, end of May perspective, the stock's actually shot up from 160 odd levels to about 350. So it's practically doubled in the last few months. And now we're seeing a bit of a consolidation in this. So if he has the patience to hold on to this one for the next few weeks, I wouldn't suggest holding or rather booking a loss at the moment. 290 is where the stock has a strong support zone. So if that breaches, then perhaps the setup could turn a little negative. But till that time the level is held, I would suggest hold on to this one. After a very steep up move, the stock's actually gone into a bit of a consolidation mode. So hold on with a stop loss of 290. Once the consolidation phase is over, we would see the stock moving to about 330 and 350 odd levels. But as I said, since the momentum for now is missing, this could be slightly patient a game.
All right, time to be patient, Vijay. Hold on to your positions in this stock and perhaps look at wait for some bit of an uptick to kick in. With that, we've come to the end of this query segment. But Kush, before I let you go, any recommendations for our viewers this morning?
Sure, a couple of stocks that are there on my radar. One of them is Indiabulls Real Estate. The stock's a little volatile in nature, so that's something that the investors or the traders should have on their mind before you take any kind of position on this one. But from let's say 3 to 6 month perspective, the stock's done phenomenally well from about 45 odd levels all the way up till 85. So it's already performing. But as I said, the volatility in the stock is something that the investor should be aware of. If you can digest that, then the stock could very well move up to 89, even 95 kind of levels in the near term. For a fresh entry, the stop loss would be somewhere close to 72, 73 kind of levels. And one entire pack which seems to be rebounding is the chemicals pack. Navin Fluorine amongst them is one of our picks. Here, if a fresh entry, if a trader takes a fresh entry, 45, 55 and 4600 are the targets, and 4475 is the stop loss that we are looking at from the near-term perspective. But again, since the markets are likely to open gap down, I would suggest just wait for the markets to settle, see where the stocks are settling, and then take a position on this one. And as a disclaimer, we've discussed these stocks as a part of our advisory service with our clients as well.
All right, those were some of the stock recommendations coming in from Kush this morning. With that, Kush, thanks a lot for joining in and sharing your thoughts with us and so patiently answering all of your queries as well. Look forward to having you on the show again.
My pleasure. Thank you so much.
Well, with that, we've come to the end of this edition of Morning Trade. But before I go, let me talk about the new listing today, EMS. That's supposed to be making its debut on the street today. In fact, issue price has been set at 221 rupees per share. And experts believe that it could see a fair bit of premium, given the fact that the grey markets are signaling a positive listing for this stock, even, in the middle of a subdued market. If you look at the IPO, it was subscribed over 75x, led by retail demand. So that's one listing we'll be watching out for. 10 a.m. is when it will make its debut on the exchanges. Well, with that completely timed out on this edition of Morning Trade, thanks a lot for tuning in from me and the entire team. Stay tuned. Coming up next is Opening Bell.